Good day to all. This will be our discussions involving considering the risk of fraud. And we are to tackle that in two parts. This is part one, by the way. Our learning objectives will be to define fraud and distinguish between fraudulent financial reporting and misappropriation of assets, describe the fraud triangle and identify conditions for fraud, also understand the auditor's responsibility for assessing the risk of fraud and detecting material misstatements due to fraud. So basically, this is audit approach, and we are going to dig deeper as to the connection of fraud with those two items. That's for number one. There's actually a paradigm about how and in what way, obviously, for fraud to occur, and that's the second one. Then third will be on the end of the auditor's responsibility. Then fourth, about corporate governance, control environment factors that would reduce fraud risks, the responses to identified fraud risks, specific fraud risk areas are to be recognized and develop, or we should be able to develop procedures to detect fraud. And finally, understand interview techniques and other activities after fraud is suspected. Our first objective is this one. We define fraud and distinguish between fraudulent financial reporting and misappropriation of assets. So fraud is basically an act or intention to deceive others. There's really deception, and others are made to believe that such is happening, but in fact, it is not. There are types of management fraud that can happen in organization. The major ones would be management fraud and employee fraud. But of course, employee fraud is not tackled here. For management fraud, on the level of management, they can prepare financial reporting and they can actually prepare the financial statements in which creative accounting, as people would use that word as a euphemism in order not to be direct with fraudulent financial reporting. But anyway, it still means the same, creative accounting or cooking of the books, as they say. Then misappropriation of assets would be if certain assets of the organization are being obtained which are beyond the authorities and normally for personal gains and advantages. Second will be to describe the fraud triangle and identify conditions for fraud. For fraud to occur, actually, there are three conditions and factors that would contribute to such. First will be incentives or pressures, because the perpetrator of fraud, also known as fraudster, is thinking that there is incentive, or basically there's a benefit to be received because of such fraud to occur or happen. And then another case or situation is that opportunity. There is pressure for this. There is incentive benefit to be obtained, but the perpetrator also thinks to do it or is doing it because of opportunities that are happening or occurring, situations that would make the person to do it. Like example would be weak internal controls in the company or business. For specific internal controls, such will be tackled, and such were tackled also in discussions for internal controls in other auditing subjects. And then we also have attitude. So basically attitude or rationalization, the thinking that it is not only me that is doing this, it is not only me who did this or that and the other and the fraud. So that person will be doing it because of that. Why fraud occurs? These are the reasons. When asked why executive fraud occurs, so these are basically frauds and fraudulent transactions committed by executives and managers. Respondents overwhelming identify pressure to meet goals. So the first factor on the top of the pyramid, that's incentive, and pressure, of course. So pressure to meet goals, that's pressure, personal gain, the incentive. The first one is pressures to do whatever it takes to meet goals, like This is the goal, so you do whatever needs to be done. Something like that concept, without thinking that it should be legal and ethical in the situation. To seek personal gain or advantage, think I won't get caught. So the attitude or rationalization, they do not consider their actions fraudulent. So they would be thinking that, oh, I am not actually doing a fraudulent transaction. Believe regulations are easily bypassed. There are rules in the organizations and they want to bypass that. Fear of losing their job if goals are not met, that's one thing also. Lack of resources causes concerns and corners to be cut. So there are some areas supposedly that should be in place to make sure that the situation would be ethical, but it's actually being cut down. That's the thing. And then lack of understanding of laws and regulations. That's also another thing of situation. They lack such understanding. Examples of risk factors for fraudulent reporting first will be incentives or pressures. We have to be stable financially speaking and profitable. And there are threats around economic, industry, or entity operating conditions. That's one area. Next is for excessive pressure exists for management to meet debt requirements. There are obligations that have to be paid short term and long term. So that's why people in the top or on the top would be preparing their reports with manipulations on the figures of liabilities. Personal net worth is materially threatened. This is true perhaps for sole proprietorships and partnerships wherein they would be liable even beyond their personal contributions to the business in the event that such a business cannot pay their obligations or its obligations, because in sole proprietorship and partnership, there is such thing as unlimited liability. But for corporations, there is limited liability concept wherein we are only liable up to the extent of our contributions. But if for sole proprietorships or partnerships, this could be an incentive or pressure case, but basically a pressure, I would say. It's not incentive. Opportunities. There are significant accounting estimates that are difficult to verify. So in that case, that's a situation that would create opportunity or create a situation that would cater fraud to occur. Well, estimates are part of accounting, and our amounts and figures contained therein are combinations of exact figures, facts, and estimates. And with that, some could be playing around the estimates because, again, difficulty of verification of such is there. Then next is there is ineffective oversight over financial reporting. Could be there is an oversight, however, the review, the supervision by managers and those at the top, especially those charged at the government, especially also for the audit committee in the board of directors, who is or are basically not part of the line functions of the business. They're not part of the operation. So they can oversee supposedly, but it's not working. It's not providing any results. Third is high turnover or ineffective accounting, internal audit, or IT, information technology staff exists. We keep on changing such staff, and then our staffs are not working their jobs well. In that case, that could create an opportunity to commit fraud. And this one, the attitude now or rationalization, thinking for reasons why they are doing this, that, and the other. Inappropriate or inefficient communication and support of the entity's values is evident. So they're thinking of their personal gains and advantages, personal interest, sacrificing the overall corporate objectives and purposes and goals. Then history of violations of laws is known. Others have been doing this, others are doing this, that's why we are doing this. That's the second one. And finally, management has a practice of making overly aggressive or unrealistic forecasts. For example, the respective targets are beyond any normal practice. In that case, management will be forced to do such measures like the fraudulent reporting. They would be thinking that, oh, anyway, these forecasts are unrealistic. So that's why we have to prepare also unrealistic figures. That's somehow funny, but it can happen in the organization or business. Next, for misappropriation of assets, we're in not properly keeping and safeguarding the assets of the organizations. First, the I or P, personal financial obligations. That could be one thing. So we have our obligations, so we will be getting monies from the coffers of the business to use to the personal. Supposedly, no, of course not. Those are separate obligations. Adverse or negative relationships between management and employees motivate employees to misappropriate assets. Perhaps there were some grudges or hatred or anger of the employees to the management and vice versa, causing the latter to hide or misappropriate these assets or really embezzle or remove or from the coffers of the business to really hide them and not to be seen anymore in the light or at the light of the day. Opportunities. There's a presence of large amounts of cash on hand or inventory items, and especially if there's no proper accounting and audit. It's just there, no proper cash count, no separation and segregation of incompatible duties. Bang, that would result to misappropriation of assets. Next is there is an inadequate internal control or IC over assets. We mentioned that already. Supposedly, there should be steps, policies, procedures that would make sure that the assets are safeguarded and protected. Next, for attitudes or rationalization, the thinking now, disregard for the need to monitor or reduce risk of misappropriating assets exists. Oh, again, this is happening, this is going to happen in the organization, so we will just leave it as it is. And anyway, it's already weak, so that's it. And of course, abandoning, disregarding internal controls. Now, our third objective is understand the auditor's responsibility for assessing the risk of fraud and detecting material misstatements due to fraud. So what is really the auditor's responsibility? Well, the auditor must be assessing the risk of fraud. However, it's not really the obligation of the auditors and responsibilities, of course, to really go over with the fraud that is happening in the organization. Remember, as discussed in basic concepts on financial statements audit, the auditors would really be looking into the material misstatements that could either occur through errors, meaning no intention to deceive others, or fraud. So fraud is part and it has to be assessed, but it's not really an obligation to examine the fraud. Fraud only that would connect to material misstatements, and such should be communicated to proper authorities, the management, the board of directors, the audit committee of the board of directors. Now, there is a mention here in the auditing standards of professional skepticism, which is this is the concept that states an auditor neither assumes that management is dishonest nor assumes unquestioned honesty. Meaning to say, we are not going to be very positive and very negative. Very positive, unquestioned or unquestionable honesty. So meaning really white, clear white, and being negative, dishonest. So we will not assume. We should be in between. We should be having the critical mindset, and we should have critical thinking to be exercised as we do our jobs as auditors. Then here are the sources of information gathered to assess fraud risks. And at the bottom, if we can say and see on this particular figure 11-3, it's like a reverse funnel. But then at the bottom, these are the identified risks of material misstatements due to fraud. On top, the bigger round or circle, we can have the information about assessment of fraud risks, communications among audit team, because again, in audits, we are in teams. We have to talk with our team members. Inquiries of management, we ask for management of certain questions we have in mind or certain procedures. Then risk factors, of course, we have to consider these risk factors like the ones we've discussed a while ago. Those are examples. Analytical procedures, ratios that we are going to check For example, our current ratio in which current assets over current liabilities, and there's already a range of that in the prior years. Then in the recent year or years, we notice that there is really a slight upward movement, or let's say an increasing trend, or there is really a large leap of current ratio. What's the reason? Perhaps higher current assets and lower liabilities. So the pressure to really meet debt requirements, so decreasing the debt. In that case, we'll be able to notice that we have to investigate such areas and other information that will be considered or that will deem fit. All right. And then we have to document our fraud assessment. It's very important because our mind and our memory is limited. So we have to write down those responses. First is discussion among engagement team. What to document? Are these important? Are they significant? So we have to put them down. Next is procedures performed to assess the risk. We have to put them down. Specific risks and our audit response. Reasons supporting conclusions that why such fraud risks occur and why fraud occurs and what these frauds are, and so on. Results of procedures performed. What happened? What did we get? Are there really fraudulent transactions? Are these fraud risk factors contributing to those? Other conditions, analytical relationships. That's 1, 2, 3, 4, 5, 6. The sixth one. And the seventh one is nature of communications. What is the way of communicating? Is it oral? Is it written or combination? But normally it would be combination, but the documentation is normally written. That is really advanced. And with that, thank you very much for listening to our first part of our discussions. Make sure to watch out for the second part of this interesting topic. Thank you very much and God bless.